How will the economy impact your retirement? And what type of indicators should you be focusing on today to make better retirement income planning decisions? Hello, ladies and gentlemen. I am here today with my good friend and co-host for these Friday editions of the podcast. Marshall Johnson's here with me.
Hey, hey.
And this is our opportunity to cover a weekend reading article with you. What is weekend reading? Well, hey, you'd know if you signed up. One email in your inbox every single Friday on trending topics in the retirement planning space, all designed to help you make better decisions about your finances, both the financial, technical, non-financial, softer side of retirement as well, all aspects of your financial life. You can find it by simply texting us the key letters WR to 866-482-9559, or you can visit retirewithpurpose.com. If you text us, we'll send you a link. You can click exactly on what you want to receive, your preferences, etc. You'll get that email every single Friday with summaries, takeaways, along with special invitations to events and webinars and book giveaways and so much more. We look forward to you signing up, because then you can follow along today. You can actually find this article directly in the show notes if you'd like to. So if you'd like to read the article first, feel free to do that. I doubt you're going to reading this article. It's we put it on a Word document, turned into 32 pages.
Yeah.
So it's a big one. It's a doozy. It comes from Michael Kitz's blog, Nerd's Eye View, and it is titled "How to Use Economic Context in Retirement Income Decision Making." I think we'll probably find a catchier name for this at the end of the day, but it is really interesting. It's an article that I got excited about because it's something that I don't know that I've ever seen analysis specifically around this topic that goes this deep, right? I've seen it around, say, maybe one or two different economic indicators. You might look
inflation.
At PE ratio or inflation or interest rates and things like that, and how do they impact how much that you can withdraw from your portfolio over your lifetime without running out of money. I mean, that's what the question's being asked. I haven't seen it this broad. And I think that is one of the things that I wanted to make sure we pointed out. I think quite often you don't see it this broad, right? You just have an advisor that's pointing to, or a talking head that's pointing to, hey, CAPE's high, so you're going to need to put your money in this annuity, or hey, CAPE is completely false and it's low, so we need to put your money in the market because it's going to grow better, right? And I think you have to watch out for the talking heads that are just going to give you one side of an argument and point to one data point in the economy to say you need to be allocated this way. This is like the gold commercials, right? I had one of your clients came up to me, Marshall, and talked to me the other day. He said, well, I decided the number one indicator on when to buy gold is when they're advertising to buy gold. So when they're trying to get you to buy gold, don't buy it. Yeah.
Oh, sell when they're trying to buy and buy when they're trying to sell.
Yeah. Exactly. I mean, it's the number one contrarian indicator, right? Is the gold commercials and the dudes spinning around their gold signs.
That's what I remember back when after the financial crisis, when gold was so high. I just remember all the guys on the side of the street spinning the signs like, we buy gold.
Yeah. That's when it happened. That's when that took off. What a business that turned into be as well. So I think that's one of the things I want you to keep in mind as you're trying to apply economic indicators to help you determine how much you should be taking from your portfolio. Don't look at it in a vacuum. Make sure you drop your biases at the door and really look at both sides of the argument.
Yeah, because right now, I mean, if you turn on the newspaper, open a Kiplinger's, listen to a podcast like this, you're going to be bombarded with economic data that's trying to help you assess or make adjustments or make changes, or at least let you know if your plan's going to work long term. And furthermore, I think most of the families that I'm meeting with today, they just want to know, hey, is this what's going on in this economy? If we have a recession, if inflation stays high, if unemployment does this, yada, yada, how does this impact the plan?
Well, and all of the talking heads are always talking about the short-term market indicators, and the reality is they're irrelevant over the long term.
They need the news of the day, right?
Or they're irrelevant over the short term. The day-to-day stock market movements, to help you make buy and sell decisions, economic and market data such as inflation rates or unemployment statistics or consumer sentiment indicators, market valuation measures. I mean, they're just notoriously undependable, right? Because you can't just look at one little marker and say, well, this is what's going to drive my decision tomorrow on whether I'm going to buy or sell the market. And I think you could easily conclude from that you shouldn't apply those types of economic indicators to a retirement income strategy.
Specifically a retirement income strategy that needs to be robust in there for 30, 40 years, as opposed to somebody that's just day trading stocks.
Sure.
Some of this may be useful for somebody that's day trading stocks, but as a retiree or a pre-retiree,
completely irrelevant or useless, but we have to be very cautious with that, right? You can't just say, oh, the unemployment rate's high, the market's going down. That's not how it works. You can't just say, well, interest rates are going up, the market's going to go down.
Right.
Now, that's happened, but it doesn't happen every single time throughout history.
Or the fact if somebody's talking about this may happen to stocks and they're 100% in fixed income. It's like, well, why are you worried about what's going to impact the stock market if you're in fixed income?
Yes, we have to be cautious on how we're using that information. But what I wanted to say is, where is this useful? This can be useful from a broader perspective, especially in retirement income planning, to do what? That is to determine how you should be thinking about your strategy on the front end of retirement. Should you be tilting that spending one way or another? Maybe a historically safe withdrawal rate is 4% or 4.5%, and you want to apply that 4% withdrawal rule. However, once you take into consideration all the major economic indicators and what that shows us for long-term viability of a withdrawal rate that is sustainable, then you might find, well, maybe right now I should take 3.5%, maybe 3.8%. Maybe I should just consider spending a little bit less. Or you might say a little bit more, right? We might just create a little spending tilt after we've actually taken into consideration all the different economic measures and what is actually providing the most useful information. Now, what is the most useful information? What economic factors are going to be most relevant to your actual retirement income planning decisions? Well, that's going to depend on the existence of a reasonable match between what the statistic actually measures and the characteristic of the plan itself. For example, a stock market valuation measure, you're going to pay attention to, say, a PE ratio, right? Maybe a 10-year, 20-year PE ratio, the CAPE ratio. You're using a stock market valuation measure to determine how much you should be drawing out of your retirement income strategy, and yet you're all bonds. You're 100% bonds. You're 100% cash. You're 100% CDs. You're all in annuities. You're all in, you're all in real estate, right? We have to make sure that the economic indicator that we're using is relevant to the way that we're actually planning at the end.
And I would also throw time in there, right? If somebody is 85 and they're talking about their withdrawal rate, if they lack the time for it to be, these indicators to be relevant, right?
Yeah, what about inflation? I mean, when it comes to inflation, how relevant is that if you don't plan on adjusting your spending for inflation, right? And we're just talking about spending habits. So to offer clarity, because there's somebody out there going, what do you mean not adjusting my spending to inflation? Right. Well, what if you are a retiree that's currently spending $200,000 a year? If you're spending $200,000 a year, you have a second home, you have 4 or 5 cars, you're traveling a lot, you're doing a lot of things you're not going to do in the future. You may actually be putting together a plan that front loads your spending. So the first 10 years you're spending $200,000 a year. The next 10 years you're spending $150,000 a year, right? The inflation measure may not be as relevant if you have a strange spending pattern, or I should say an unusual spending pattern
or a large
that is
lifestyle
different than the norm or different than the average. We just have to make sure that the characteristics and the time frame that we're looking at are relevant. The time frame is very important, right? A lot of these indicators, as we're going to see, like these economic indicators, as we're going to see, aren't that relevant if we're looking at a 5-year, 10-year spending decision. If we're looking at a 25-year plus spending decision, that's when a lot of these factors become much more relevant. And the first one we want to talk a little bit about is one of my favorites, PE.
Oh, the PE? Yeah, the price the price divided by the earnings, right? PE is often quoted. You'll hear people talk about, well, the PE is high. Well, what's that mean? It means you're paying a higher price for an expected earnings. But you've got some great stories on PE.
Oh, yeah. I mean, it's price over earnings, right? So it's price over earnings. How much you paying for something and how much is it actually earning? This is something that is used widely in any business decision. And when you're buying a stock, you're making a business decision. If you're buying the S&P 500, you're making a business decision. You are buying companies. You're buying a company, you're making an investment, you need to know how much they're actually making, right? Am I ever going to get my money back? And there's more clarity around this decision when you're buying a small company and you're buying the whole thing. All right, let's start with an example. So let's say that you want to go out, you want to invest in a business. Give me a bit. What kind of business you want to invest in?
Well, let's do Carl's studio over here, our videographer.
Yeah,
here.
we got our videographer.
Carl's going to have a fantastic studio one of these days.
Carl is really good at what he does, right? Let's say that Carl's business is earning $100,000 a year.
Okay.
So Carl's
Carl.
business, his production studio, is making $100,000 a year, and you want to come in, you want to buy that studio. What do you think a fair price might be to buy a business earning $100,000 a year?
Let's say $800,000.
800,000. Now, why would you pay 8 times earnings, right? What would be the reasoning behind paying 8 times earnings?
Well, you think, like a PE of 8, yeah, that seems pretty fair. It's historically below, valuations.
Well, you believe in Carl.
I believe in him.
You believe in Carl.
He's the man.
Let's go to what's most important here. You believe in Carl. You love his work.
He's got to stick around, though.
You believe in the growth of the business due to what Carl can put into it, right?
All right.
You believe that earning number of 100,000 a year is going to go to 150, 200,000. You believe it's going to grow, and that makes it a good buy. What if I said Carl wants to sell his business that's earning 100,000 a year for $3 million?
Oof. A little spendy
$3
bud.
million here.
A little spendy bud.
Yeah, you're gonna have a tough time
I'm
paying
start to
$3 million.
doubt his
well, what are those
outlook.
two PE ratios? The PE ratio of 800,000 is the price. It's earning 100,000 a year. That's a PE of 8. If we look back historically, the average Shiller PE ratio, Shiller 10-year inflation adjusted PE ratio for the broader stock market, we would have seen an average of 8 at the beginning of every bull market. If we look at an average of 30, that is
a peak.
That's about where we're at today, right? So things are getting pretty expensive right now if we look at PE ratios over time. And so what is PE ratio? Just to review, a PE ratio divides the price of a security or index by recently reported or expected quarterly earnings. So usually when you're talking about a PE ratio, you hear it talked about on the television, you hear them talk about it on the radio. They're talking about a short-term PE ratio that's reported on their quarterly earnings, and those short-term earnings can be very volatile. I mean, we've seen some of these, right? A stock can
massive swings,
massive value just because they had 1 quarter of bad earnings. Those can be great purchase opportunities or investment opportunities because it's a very poor predictor of future returns in the broader stock market index, let alone an individual company.
Because things can swing wildly in the short term. Yeah.
Well, and then there's CAPE. That is cyclically adjusted price to earnings ratio, the CAPE ratio. So it's using a longer term average. That's typically a 10-year average.
Yeah.
10-year average inflation adjusted earnings is the denominator of that ratio and is much more useful for developing longer term total return expectations at the end of the day. So you might hear us talk about Robert Shiller from time to time.
Yes, sir.
Well, Robert Shiller, Case-Shiller Index, he's the one that really developed this and won a Nobel Prize for his work in developing the Shiller PE ratio because it's one of, if not the number one predictor of future stock market returns, again, over the long term. And that's what makes it relevant when we're talking about building retirement income strategy. If we're looking at the CAPE ratio over a short-term window, 0, 5, 10 years, it's highly irrelevant. We need to get, really need to start getting around 20 years of earnings history before it becomes a really relevant measure.
Yeah, that time window of earnings really helps us understand whether this is relevant to our needs as for preparing for withdrawals from a retirement portfolio.
Yeah, and the numbers are pretty amazing, right? If we had a low CAPE, around 5, historically, your safe withdrawal rate would have been around 8% per year. If it was high, like it is today, so a high CAPE ratio around 25, and we're actually higher than that today, but a high CAPE
32.
ratio of 25, that puts you about a 4.5% safe withdrawal rate, right?
Still
on a really high. Yeah. And then that's still around 4%. Now, why you might say, well, why do they say 4% is not safe then? There's a lot of other factors that go into this, but this is one of the key factors that individuals and analysis and economists are using when they're saying 4% may no longer be a safe withdrawal rate, because they want that to be in the 95% confidence interval. So confidence that you're going to be able to spend from that over the long term and not run out of money. Well, if you look at the chart, that's probably closer to, say, 3.5%. And PE ratios today aren't 25. Again, they're more like 32. And we want to take other things into consideration, which is what we're going to do in just a moment. But first, I want to say, you might want to take things like this with a grain of salt. Once again, you want to take the CAPE ratio even specifically with a grain of salt.
Even the CAPE is better than a traditional PE ratio, but if your advisor's spitting out about the CAPE ratios and withdrawal rates, we haven't even got statistical 30-year bands yet to judge.
Yeah, well, and some researchers have said there's been changes in
the accounting
rules,
practices,
trends in dividends, share buybacks, reinvestments. There's different reasons that it may be elevated today more than it has been historically, just due to some of these changes in accounting principles, share buybacks, reinvestments, et cetera.
And really, if you don't have much of a stock allocation, then it's really pretty irrelevant as well. So we start to look at how well the CAPE will work. It's like, well, the higher the stock allocation, the better it's going to work. So if you're 60, 70% equities, 80% equities might be a little bit more helpful from a predictive nature.
So we talked about one valuation measure, right? It would have been CAPE or your PE ratio, average of 10, 20-year period, in order to make it as relevant as possible to help you determine, well, should I take 4% or 8% out of my portfolio? That is one of the key economic indicators that you want to use, not one that you want to use in a vacuum. Number two is your nest egg. So this is a really interesting one. So they actually graphed out inflation-adjusted balances of portfolios that would have been built over a 35-year saving horizon, saving $1,000 a month, systematically inflation-adjusted savings of a 60-40 stock portfolio. So you're taking $1,000 a month every month out of your paycheck, investing it in this 60-40 mix over 35 years. And what they found is that there's a very high correlation of the sequence of returns risk as it correlates back to your withdrawal rate risk, because it's so interesting, right? The size of a nest egg at retirement, as built up through regular savings behavior, is subject to a sequence of returns risk. The risk that you're going to have a loss on the front end of retirement. So the larger that portfolio, so the nest egg gets really big, what happens to the sustainable withdrawal rate? Historically, it drops.
Historically low.
And you go, wait, if my balance is larger at retirement, I can't take as much out of my portfolio.
Because
you can't take as much on a percentage basis out of your portfolio.
You've historically been above average, right? You've had historically above average returns. So what they're saying is forward looking, the returns are going to be below average. So therefore your withdrawal rate is actually smaller.
Yeah, there's a revision to the mean, right? There's always a reversion to the mean, and that is what's happening. And so you could say today, I mean, where are we from a PE ratio? And go, well, PE ratios are really high, so maybe I need to dial down my withdrawal rate. Portfolio values
are really high.
Very high, right? Historically very high. So I need to consider dialing back our withdrawal rate due to that as well. What are those withdrawal rate bands? Well, if we were in a high environment, a high nest egg environment, that would be about a 5% withdrawal rate that would be safe. If we were in a low nest egg environment, so you didn't see a lot of really great returns historically, that means your likelihood of seeing better returns in the future are good. Again, reversion to the mean. Now we're talking about 8%. So it's it's interesting, right? Because we talk about this from a safe withdrawal rate perspective. People go, oh man, safe withdrawal rates are down. I can only draw 2 or 3% of my portfolio. Yeah, but you got 2 or 3 times what you would have if you weren't in the same market.
Yeah. You got to retire, 5 years younger than the previous example.
Yeah, so there's a balance that's going on there, and I think there's some other good news there. Today's nest egg measure, by saving $1,000 a month over 35 years, inflation adjusted, it'd be about $1.3 million, and that's not low from a historical perspective, but it's not approaching all-time highs, because if we went back to the year 2000, that 35-year savings value would have been over $2 million.
Wow.
Right? Over $2 million is what you would have seen if you would have saved over that 35-year period ending in 2000. What happened then in 2000 to 2011? We experienced the lost decade, right? And I think if you also, furthermore, you look at that chart, historically, you'll find that it hasn't changed much. We're not that far off of the mean over the last 30 years.
That really is surprising. That chart right there really says, hey, we're nowhere near the valuations we saw in the .com era.
Yeah, and so I wouldn't say it doesn't contradict the conclusion you draw from CAPE, right? Nope. But it does support more cautious approach to retirement spending, and it may temper some of the alarm that you might have saying, oh, wow, CAPE ratio is at 32. I'm not paying $3.2 million for a business earning $100,000 a year. I'm getting out of this market, right? Well, hold your horses, right? Because there's some other things that you need to take into consideration. And one of those big ones is going to be inflation, right? We need to be paying attention to inflation and how that impacts us historically. May not want to give up our stock allocation because that may help make the inflation risk less relevant.
Yeah, so I'm reading this article. It's really in depth. But as we get through that first section there, Casey, where it's talking about inflation at the very end, for inflation, we need to look at average rates over 8 years or more to find explanatory power at or above 0.3. This means that short-term inflation rates, like year-over-year annual rates commonly quoted in the press, like today, have essentially zero straightforward predictability value for retirement income planning.
Zero relevance.
Yes,
where does that become relevant?
It gets the headlines, right? Tune in.
You don't actually see a correlation that is relevant until you get to about an 8-year average inflation rate. And I think that should be encouraging for some. Right?
And it's worth watching, right?
Yeah.
It's definitely part of what we're analyzing on a regular basis, but we need to see more than just a spike year over year for it to be a problem.
But what's interesting about this is it's an inverse measure as well, right? When most would say, well, inflation's really high, I need to reduce my withdrawal rate.
No,
it's actually the other way around.
Yeah, if it's really low, you need to withdraw.
Yeah,
because you're going to revert to the mean.
The mean, yeah. So, but we kind of lose track of that. But that's why these averages are so valuable. So, where are we today? We're still pretty low today, right? We're still pretty low because over the last several years, we've seen inflation under 2%, sometimes at points even negative. And so we're still in a historically low mean. And now we're seeing some higher inflation rates start to creep in. So what do you do about that? And it's kind of hard to make a decision. What would you say to an investor that's going, yeah, but inflation's really high right now. I guess that means it's going to be lower in the future, so I can spend more today.
Yeah, but I will say the withdrawal rate never really dips below 3% on this whole chart going back to 1880. So I still feel pretty good about that. You mean to tell me I can withdraw somewhere between 3 and 8%? Like, just keep an eye on it and work with your advisor to make sure you're watching the figures, watching your withdrawal rates, watching the size of your nest egg.
Yeah, you don't see a big swing, right? You don't see a big swing to the downside. I should say.
It's
There's
big
some
swings to the upside
because you can catch the market at the bottom and be able to take, a pretty big withdrawal, of course. But I think that right now, looking at where inflation is, you can't make a decision at this point because you don't know, is it transitory? Is it going to go away over the next 12 months? Is the Fed going to be able to get it under control? If the Fed's able to get it under control over the next 12 to 24 months, then our long-term average inflation rate may still be relatively low. And that tells us what? That means we might actually want to be a little cautious about where our withdrawal rate is starting, because that means, hey, if they do get it under control, when are we going to have inflation, right? When are we going to have inflation? And it begs the question, well, maybe the Fed can control it forever, right? Now, are they going to be able to control inflation forever? And this is just for the sake of conversation and thought, right? Because again, and I'm saying this because we can look at these numbers over the last 100, 150 years, and where there's periods of time in here where the Fed had no control. How relevant are these things today when the Fed has much more control today than they did 100 years ago? If we're going to look at numbers, they need to still be relevant. And I think the world moves at such a fast fast pace, a lot of these things they're really interesting to consider, whether it comes from nest eggs, whether we're talking about inflation, whether we're talking about interest rates or PE ratios. It's all interesting fodder for conversation, but how relevant is this stuff? They say that the past tends to repeat itself, and history is the best predictor of the future. And sometimes I question that. Sometimes I question how realistic that is. If Moore's Law really does come into play and we continue to see the technology and the world continue to evolve at a faster and faster pace, we could be living in a completely different environment 10, 20 years from now. And a lot of these measures, take PE, for instance, take CAPE, for instance. Rules change, laws change,
accounting practices,
politics change, and that makes it very difficult to take any economic indicator, look at it over the long term, because you have to look at it over the long term in order to get enough statistical information to make it statistically relevant. So you look over it over the long term, and it's becoming less statistically relevant as you're looking at it over the long term, because
your retirement's
these aren't
getting
just
shorter.
Numbers, right? Yeah. This isn't just me hitting like 1,000 golf balls and trying to figure out, has he hit a phase? He hit a hook.
Yeah, he's coming over the top.
There's relevance to that because it's in a vacuum. I don't think there's hardly anything in the market that's in a vacuum, which just takes us back to don't make decisions on day-to-day economic indicators. Don't make decisions on long-term economic indicators. Make sound decisions by following a planning framework that allows you to cover all of your bases. You know that you have a strategy, you have a plan that'll succeed, whether those economic indicators are right or they're wrong, right? You're planning for the best. You're preparing for the worst.